you cannot have a C-suite till you're like $20 to $25 million. I'll hold strong to that. I've seen guys here in Florida that have a C-suite and they're collecting $5 to $8 million. I mean, you're spending over $1 million of that $5 to $8 million on a C-suite. What is the point?
I didn't think I would ever do a fucking podcast. I didn't ever imagine doing that. It made me realize that my purpose is to help others reach the goals and reach their full capacity. And if I can impact somebody's life, that is bigger than money. That is bigger than anything else.
Welcome to Livestream. I'm your host, Dr. Alex Plains, with my co-host, Jeremy Applegate, where we teach you how to stream your life. Today, I have an amazing topic that I want to talk about. I've been asked this over and over again in all the events we go to. I have friends of mine calling me constantly about this topic, and it's about when is the right time to exit and how to prepare for your exit.
That's an interesting topic, and we get a lot of feedback from that topic.
Yes.
Good and bad.
A lot of good and bad.
Yeah.
So there's a lot of conversations out there in the marketplace about 5X, 7X, 10X, affordable dentures sold for 20X. But let's start focusing on some amazing and concrete realities. What are the steps that you need to take to increase your multiples when you're exiting? What are realistic numbers to expect from a person-to-person sale or a strategic buyer, or are you going with private equity? Let's talk to our listeners about the difference of the three.
Yeah, I think that, obviously, EBITDA is the impact on all of those. But as a business owner, what do you think?
It depends on what you have, right? So if you have one dental practice, I wouldn't be so concerned about EBITDA. I would be more concerned about what your collections are and how your accounting is, clear and concise and transparent. It's very important to realize that the EBITDA number is very, very important. Once you get above 3 to 5 practices, at that point, you should start looking at EBITDA of 18 to 22% after all management fees have been paid for. But how are you going to do that? As you know, Jeremy, you're the experts in numbers. There's so many different types of accounting. I mean, you got cash-based accounting, and then you got accrued accounting. Can you tell our listeners a little bit about what accrued accounting is?
Yeah, accrued accounting is sort of, lack of a better description, planned accounting. I'll call it planned accounting for the listeners. It's a situation where, it's your bank accounts and your accounting's never going to match because you're forecasting and you're preparing the business.
Yeah, and you're also taking into account previous production.
Correct.
That hasn't been collected yet.
And with cash accounting, everything is an expense, right? Accrued accounting, you're going to have a balance sheet available. You're going to be able to move some of your equipment, your computers, your whatever onto your balance sheet,
Correct.
Which in turn will be a win on your P&Ls, your profit and losses. But it's difficult to get into and it's difficult to understand because if you've done cash for so long, everything's an expense.
It's so hard to
everything's
transition.
an income. Yeah, we did that, right?
Yes, in 2021, we went ahead and started our transition to accrued accounting. It has its benefits. It gives you, the lenders more. It gives you more accessibility to cash, for lending and to get more loans if you need to. Your EBITDA looks stronger, it looks better, but there's, down effects with it, which means if the money is not collected, it's just numbers. It's not real cash based going into your accounting. So if you're preparing for a sale, I think it's very important that you start creating at least the next 3 to 5 years. Get yourself an amazing CPA or an amazing accounting team to help you allocate, like Jeremy was saying, equipment expense into a balance sheet. You go get an X-ray sensor into a balance sheet. You make a big infrastructure expense with IT. You put that in the balance sheet. You don't go ahead and put that in your profit and losses, which then downgrades your EBITDA and it makes your business look a lot less profitable.
Yeah, and I think that's where business owners sometimes make a mistake. I don't want to say make a mistake, but sometimes make a mistake because they'll expense everything knowing that they have to pay tax on it, right? So they try to get all these expenses created so their tax bill goes down. But you don't understand. You're helping yourself personally, but you're not helping the business.
That's correct. And a lot of doctors, they like to take cash, home with them. They're like, okay, I'm not going to pay, like you just said, less. I want to avoid tax expenses. Right. But at the end of the day, you're down valuing your business because if you're going to go sell for 5X, for example, 3 to 5X, For every dollar, you're losing $3 to $5 of net worth that can go at the sale.
And the potential buyer is not going to share that information with you, right? Because they're going to try to get it as cheap as possible.
Yep.
So you're doing yourself a disservice by doing that, because they're like, oh, well, you expense everything? Okay, great. Well, your EBITDA is not really what your EBITDA really is.
Yeah, so it's great you just brought that up. I was going to talk about that. It's very important that we understand. You can get an offer from a strategic. Let's go over the difference. So I already talked, doctor to doctor sale. You sell from one doctor to another. Normally a broker's in the middle. Then you got the sale of you with a strategic buyer. Who is a strategic buyer? You're talking about companies like North American Dental Group,
DSOs,
Smile Brands, Heartland Dental. So what do they do at that? They come in with an LOI offer. They give you the LOI. You look at the numbers. They say your business is worth X amount of dollars, but then they got a burnout period or earnout period, which at the end of the day, they give you these higher multiples. But in all reality, 6 months to a year later, once they take a deep dive into those P&Ls, they're like, no, your business is not worth that amount of money. It's worth this amount of money. So you got to be very careful when you're starting making these deals, and don't get too excited till you eventually have the whole offer pretty much after the discovery phase.
And I think that, the money obviously is the number one thing in a deal with the DSO, but you also have to understand what your role is after purchase, because some of these guys will make you stay on 3 to 5 years, and some of them will make you stay on a year to 16 months to 18 months. It just varies from DSO to DSO.
That's correct.
But find the right deal for you. You know what I mean? It has to be a balance. These guys that are going to give you a high multiple, they're probably going to ask you to stay on longer.
Longer, yep. And you're going to have to put a lot more sweat equity into it, which is okay if you're looking. So that's why it's so important. If you're looking to getting out of the chair or exiting at some point of your life and you want to go through these routes, I would recommend to be getting ready 3 to 5 years beforehand for this type of transaction to take place. And then you got deals like private equity, where private equity, you basically run your DSO the way you want to run it. You have control, but private equity gives you the funds to continue to grow and expand, but you start losing control. You lose complete control of your organization.
Thank you for saying
because
that.
you gotta give the money back to Wall Street or the private equity firms.
Thank you for saying that, because it's true. They come in, and it could be a private equity firm that doesn't have any idea what dental is all about. They just want to get into the dental industry because they heard say great things about it, right?
Yeah.
And they start coming in and they start telling you what to do because it's their money. Their investors want a return on their investment, so they're going to hold them accountable for it, right? And then in turn, if you're underperforming as a DSO, they're going to step in and take care of that. I've been involved in that situation where I was at a DSO. We bought private equity bought us, and then another private equity came in and bought us a year and a half later, and it was underperforming. And guess what? The C-level people were
completely lynched. Yes, that happens a lot. And that all needs to be detailed. If you have a DSO, which is what we call an emergent DSO, 5 to 8 offices, you got to make sure that you're prepared for that and you create a good structure that works for you. But one important thing that I want to talk about, if you're going to get yourself in these type of deals, make sure that you have cash saved for the accounting team to do their investigation and get everything straightened out for you, but also the legal team. You got to make sure that your legal team understands exactly what you want to get accomplished out of this, because by the time you know it, you're wasting $20,000 to $50,000 getting this deal done minimally in order for it to happen. I mean, we got a deal one time done in Orlando. I literally spent $25,000 of legal fees, and the deal broke. It never happened because the landlord didn't want to give us exclusive rights for a dental space. So those type of deals really, really suck. So you got to also be transparent from the very beginning in the deal that you want to get done, and you got to work with your legal team to make them understand that you want a good deal, or what we call a friendly deal accomplished.
No, I agree with that 100%. I want to understand also, I think they need the listeners and the people in this situation that potentially could sell, like, how much infrastructure do you need, with respect to this? I understand single office, purchase and on collections and stuff like that. It's pretty simplistic, but what about an emerging DSO and higher? I mean, what kind of infrastructure do you think they should have?
It all depends on, do you have the sufficient cash to have a C-suite, right? Do you have, remember, there's break points. If you're not doing $20 to $25 million of collections, you cannot afford a C-suite. Doesn't make any sense to afford a C-suite. So you can either rent a C-suite from, through an MSA agreement, or you can go ahead and partner with a strategic buyer, and at that point, they'll bring the infrastructure to you. So there's no reason for you to invest in that infrastructure at that point.
Yeah, I think that, I'm not trying to discredit the title process or anything like that, but sometimes I feel like, people bring on their buddies, and all of a sudden they're the chief financial officer, they're the chief operations officer, and you're like, oh, what's your background? I watched cars for a living. I mean, not discrediting that, but it's just like a completely different industry and a completely different role.
Yeah, that happens a lot, and I've seen a lot of great companies that have amazing potential fall in that trap of bringing a buddy or somebody they like into a C-suite position, and then by a year or two, the company completely destroys its reputation.
I think we are still in that position. Like we haven't brought on buddies in leadership roles, but we have not really declared anybody, chief.
Well, we don't have any C-suites in our organization.
That's correct. You're the only C person.
Yeah, I mean, that's just because I'm the owner, but if not, it really wouldn't be a title,
Yeah.
So I believe that in the first, while you're building your business and you're growing your revenue stream and collections and dentistry, you cannot have a C-suite till you're like $20 to $25 million. I'll hold strong to that. I've seen guys here in Florida that have a C-suite and they're collecting $5 to $8 million. I mean, you're spending over $1 million of that $5 to $8 million on a C-suite. What is the point? It just doesn't make sense to me. You're not going to get higher multiples because you have a C-suite, because at the end of the day, it's the EBITDA that matters. So it doesn't make sense to me. Why bring? I get it if you want to go to 20 to 25 offices in the next 6 months, but if you're not going to do that, what is the point?
Yeah. No, it's relevant. It's definitely relevant. And I like the point that you just made about, unless you're going to grow crazy, bring them in. But if you're not, if it's a slow process, then, those titles are not necessary. And I agree with you with 20 to 25 million for sure.
Yeah, you have to have it. And it's very important for doctors that only own one office or own one office. The EBITDA is not as important as your collection. So please understand that. People are so confused of the EBITDA. It doesn't matter if the EBITDA is 5%, but you're collecting $3 million. At the end of the day, you're going to be able to sell that office from 80 to 95, 100% some deals of what it's collecting. So please understand that, because don't be confused with the whole EBITDA thing that's going on. Everyone's talking about it, but people don't really understand how these transactions really do work.
Yeah, it's a win, and we didn't even talk about this. Like when a single office or multiple group practices comes to any kind of a buyer, obviously you're taking yourself out as the owner, right? So if you're the practicing dentist, all that,
the wages, the distribution,
data that you create, yes, whether it be production or a distribution, that gets taken out of your business, and it's set there as a fluff number, I guess I could say.
Exactly. So to conclude this, I want to state that it's very important that you get a strong accounting team that knows what they're doing, specifically in the space that you're in. For us, dentistry is very important because there's so many different facets of our business that we got to pay for, different vendors that we got to deal with, allocation of funds in different buckets. So it's very important you get a good accounting team. If you're going to do accrued accounting, it's even harder to find a good accountant that can do accrued accounting. You also got to make sure that everything is balanced at the end of the day. That's why we founded Livestream U, to help doctors like yourself come up with solutions to these problems so they don't happen to you like they happen to me.
We had so many people at an event a couple of events ago were like, I don't even understand what my CPA is giving me. Remember that?
It's just basic profit and loss statements. We all go to our local CPA that has no experience in dental, right? Then you go ahead and they start, putting things all together, cost of goods, right? They don't break down marketing. They don't break down implant parts. They don't break down,
just
materials.
don't even break down
Yeah,
your
materials
revenue.
from your supply. And by the time you know it, it's all convoluted. They don't break down your benefits into 401k benefits versus actual payroll. And by the time you know it, you're like, why are all this tied so much together? And you can't understand your financials. So you don't understand that you're spending 7% in materials where you should be spending 3 to 4%, for example, or you're spending 8% in marketing where you should be spending 3 to 4%. So that's why it's so important that you have a good accounting team, and preferably they should be giving you your profit and loss statements every single month.
Every month.
Rather than quarter. I mean, I have CPAs that sometimes they're giving me my P&L 6 months down the road. By the time I know it, the 6 months is down, and you don't even know how your business is actually being
The
is
trends
running.
have changed. Businesses changed. Trends have changed. And, I love that you mentioned Livestream U, and that's for your passion, right? That's your baby is Livestream U. And we reach out to us. We have plenty of contacts. We have accounting CPAs that we trust and value their expertise. We have everything you could possibly need, to help you out through that process.
Absolutely. So I hope you guys enjoyed this podcast. Follow us at Dr. Alex A. Plains, livestreamu.com. Look forward to seeing you there.